Well, David, we chatted on Monday about how the rand was actually going nowhere, stuck just above 7.40 against the dollar. We've had that clear break now below that level, trading as firm as 7.32 today. Is this just a case of dollar weakness in your view?
I think a number of factors filtering through. As I indicated on Monday, everybody was waiting for the Fed statement, and they are, sailing a steady ship, steady as she goes. Rates on hold for an extended period of time. And as I spoke on Monday, I did say, that monetary authorities around the world will be absolutely terrified of any double-dip recession, and moves on interest rates they'll be very reluctant, very slow to do anything until we see some employment growth and we actually see some public sector or some private sector growth in the economies coming through. So that was the one issue that the market was looking for. The other one, of course, is that yesterday one of the rating agencies removed the negative rating watch on Greece. That took some of the steam out of a strong dollar as far as the euro was concerned. The pound has rebounded nicely. Equities are buoyant. Gold has rebounded. So stars really aligning, and we're seeing that strength coming through into the rand at the moment.
And of course, Alicia mentioned that the rand was tracking the euro to some extent. Of course, we also have the Canadian and Australian dollars improving against the dollar at the same time and actually moving close to parity against the greenback. And of course, these are two currencies that South African, the rand, is also quite linked to, aren't they?
Well, absolutely. So what you're seeing is commodity currencies like Canadian dollar and Australian dollar doing very well. We're seeing high-yielding currencies doing well. We're seeing emerging market currencies doing well. The rand fits into all three of those categories. And for now, unless we see some internal shock, we're going to see some demand for the local unit from foreign investors as they look to boost their yield and in fact also flows into the equity market.
You mentioned the FOMC meeting last night, keeping interest rates on check for the foreseeable future. Of course, we also had the Bank of Japan reporting back as well, and it's increasing its liquidity measures in Japan, putting another 20 trillion yen of funds into the banks. So loosening monetary policy in some jurisdictions.
Well, that's the point at the moment, Stephen. A lot of this liquidity is coming back. There are question marks about what the US is going to do, and are they going to remove some of the liquidity they've added in the coming weeks as the rollover of those assets come up. But Japan in a very different situation at the moment. The Japanese economy out of the G7 probably in the worst boat of all. They've got no growth. They're worried about deflation. They've got high debt, and really it's no surprise that they're adding to the liquidity because they certainly don't want to be the culprit that drags the whole world down further.
Then, of course, we had those retail figures out just a short while ago. This follows on from consumer confidence numbers out yesterday, slightly better than expected on the consumer confidence front, and also better than expected on the retail sales front. So things starting to look a bit more positive for South Africa, although we are still seeing a contraction in the retail sector.
I think the combination of numbers have been relatively good, Stephen, and it points to probably the MPC next week keeping rates on hold. There's no real reason for them to drop rates unless they're concerned about the employment picture and might be inclined to drop rates slightly on the back of that. But I think rates will remain on hold, which will add to the attractiveness of the yield play, the carry play in South Africa. And I think the combination of economic data that we have seen in South Africa has pointed to the fact that we are following the rest of the world into a better picture.
Well, David, you mentioned a little earlier that one of the ratings agencies had removed its negative rating watch on Greece. And of course, we know those European finance ministers had been discussing issues in Greece. They didn't really come up with anything concrete to help that country, though, but it looks like the market has taken some comfort.
Yeah, what we've seen is simply a repositioning or some of the positions being taken off the table. I think, when everybody is short or long a particular currency, and we've seen that now in the euro and against the pound, that just about everybody that you spoke to was heavily bet against the euro, heavily bet against the pound. Some of the factors that were inducing those bets have now been removed and taken off the table. And we've seen a rebound. I don't expect that we're going to see a massive jump up in the euro or the pound for that matter, besides these corrective price actions. I think there's still a lot of question marks a lot of questions to be asked, particularly in Europe, but around the globe for that matter, because fiscal deficits, as I've indicated in the past, are going to be the talking point for a long time to come.
Well, what does this all mean for the rand going forward from here then, David?
I think for the medium term, Stephen, the South African economy is looking better. The interest rates are in our favour. The commodities are in our favour. I think for the foreseeable future, in any case, I'd be very surprised if the rand doesn't try to get through 730 towards that 725 level. Of course, the big level now on a close basis is 720. That's the target for me, the medium term target. Once we get there, we'll have to reassess the situation.